Another RBA pause as expected in October, but growing expectations of rates higher for longer. Our latest thoughts for domestic and global markets. Michelle Bullock's first policy meeting as the new RBA governor followed a similar script to the previous three, with the no change decision statement almost unchanged from last month's, but still the warning that further tightening of policy may be required. Another hike to 4.35% as early as Melbourne Cup Day remains our expectation, as does our forecast that we've shared throughout the year that rate cuts will most likely be a 2025 story, not early to mid-24, and events over the past few weeks appear to support this view. While the focus for rates is often on official cash rates, term rates, including government bond yields, are just as important, and the recent surge in bond yields in the US is having a material impact on the markets, even while the US Federal Reserve and the RBA have kept rates on hold. The US 10-year has jumped to above 4.75%, its highest level since 2007, just prior to the GFC, and, as the chart shows, above our 10-year yield. This has a number of implications, beyond simply implying that the Fed will need to keep rates higher for longer. The value of the US dollar continues to strengthen, taking the Aussie dollar down to below 63 US cents. Equity markets are under pressure as valuations of future earnings are diluted. And the higher for longer theme makes soft landing scenarios harder to reconcile with the reality that taming inflation takes time and typically requires a deeper economic downturn. Inflation rates here and around the world are still expected to steadily moderate, but factors that will challenge the pace of normalisation include the rebound in property prices as supply fails to pick up versus population growth, resilient jobs markets as demand for labour remains persistent, and higher energy prices, even with government subsidies and support. The rebound in the oil price has mainly been driven by supply cutbacks, especially from Saudi Arabia and Russia, but global demand has also held up resiliently, and here the lower Aussie dollar means a higher cost for oil imports, so a higher price for petrol at the bowser. The demand side will be challenged by the global downturn, although China's stimulus measures are having some success, judging by their recent activity data. The next inflation data of note in Australia will be the third quarter numbers out on October 25th, and these are likely to continue to show falling costs for goods, but not for services. Services inflation continues to be stubbornly high around the globe, and here tight labour markets, together with abysmal productivity, is a major factor. Our unemployment rate remained at 3.7% in August, despite the strong rebound in population growth. So, while the ongoing strength in labour markets is supporting the economy, this resilience simply means the RBA will need to keep its tightening bias intact for longer. To achieve real wages growth and a lower unemployment rate, we need a lift in productivity while also decreasing core inflation, which will all take time. In summary, the next move from the RBA is still more likely to be up than down, and the next read on inflation on October 25th will be critical. But markets are continuing to adjust to the rates higher for longer scenario and its implications. And that's the market update from Leveraged.